It wasn't a sudden trade dispute, it wasn't a diplomatic miscalculation. It wasn't even a specific military maneuver in the Pacific. It was the structural fragility of a leveraged system. Finally meeting its limit, the headlines focus on Beijing, they focus on dump orders, they focus on currency pegs, but these are merely the sparks. The fuel was piled up decades ago. The pattern is unmistakable. History shows that when a dominant power relies on debt to maintain its standing, and a rival exposes that leverage, the result is never a soft landing, it is a cascade. We will examine this dynamic through three specific historical precedents, from the Roman denarius to the Spanish Peace of 8 to the British pound sterling, and finally, we will map these exact coordinates onto the current friction between Washington and Beijing. Consider the Roman Empire, specifically the transition from the Antonini stability to the crisis of the 3rd century. The peak dominance was absolute, but the costs of empire were rising border defense, bureaucracy, bread and circuses. The treasury could not keep up, so they chose the monetary shortcut. Under Septimius Severus and later rulers, they debased the currency. They mixed copper into the silver denarius. They thought they could print prosperity. But the arithmetic is merciless. Inflation surged, trust evaporated. The legionnaire on the frontier found his pay worthless. The merchant in the forum refused to sell grain for coin. They fled into hard assets, land, gold, anything the state could not debase. The middle class was hollowed out. Society fractured. It was a slow grinding collapse of confidence. Just like the Roman debasement exposed the rot at the core of the empire, the Spanish experience reveals the danger of relying on foreign inflows. In the 16th and 17th centuries, the Spanish Empire was the master of the world. Galleons laden with silver from the Americas flowed into Seville. It seemed like infinite wealth, but it was a trap. The crown, particularly under Philip II, spent this wealth before it arrived. They financed endless wars against the Dutch and English. They imported everything, they produced nothing. When the flows slowed or when the costs of war spiked, the illusion shattered. Prices skyrocketed. In the price revolution, the average Spaniard could no longer afford bread. The wealth did not build industry, it built inflation. The aristocracy held land, the peasantry starved. The middle was crushed between rising costs and stagnant wages. The empire defaulted on its debts again and again, not because they lacked resources, but because they lacked discipline. Just like the Spanish reliance on silver masked deep structural weakness, the British Empire's decline shows what happens when the world loses faith in the reserve currency. By 1914, London was the world's banker. The pound sterling was as good as gold, but to world wars drained the coffers. By the 1960s and 70s, Britain was running on fumes. They maintained the pretense of a global empire, but the balance sheet told a different story. The United States and other creditors held the leverage. When the pressure mounted, specifically during the Suez Crisis and later the 1967 devaluation, the government tried to hold the line. They tried capital controls, they tried austerity, but the market was stronger. The pound collapsed, import prices soared. The British saver saw their purchasing power vanish overnight. A distinct human tragedy played out in the suburbs of London, where retirees on fixed pensions found they could not heat their homes, while the well-connected moved their capital to Wall Street or Zurich. The pattern repeats in 7 distinct stages. Stage 1 is the era of undisputed dominance, where the currency is unchallenged and debt is cheap, allowing the hegemon to consume far more than it produces. Stage 2 sees the costs of maintenance rise, driven by military overreach or social entitlements, forcing the state to borrow beyond its means to maintain appearances. Stage 3 is the turning point, where the government chooses the easy path of currency devaluation or money creation, rather than fiscal discipline. Stage 4 brings the initial waves of inflation, often dismissed by authorities as temporary or the fault of greedy speculators. Stage 5 is the flight to safety, where smart capital quietly exits financial assets and moves into tangible wealth like land, gold, and commodities. Stage 6 is the social fracture, where the gap between the asset-rich and the wage-dependent becomes a chasm, leading to political polarization and unrest. Stage 7 is the final reset, where the old currency is abandoned or revalued and a new paradigm emerges from the wreckage. Just like the British Empire faced a twilight of debt and denial, current data suggests the United States has entered the later phases of this cycle. The warning signs are flashing red. We see the weaponization of the dollar, driving rivals to seek alternatives. We see central banks, particularly in the East, accumulating gold at a pace not seen in decades. We see a domestic deficit that grows regardless of economic conditions. The incentive for foreign powers is no longer to subsidize American consumption, but to insulate themselves from American instability when a major holder of debt like China shifts its strategy from accumulation to liquidation. It does not cause the crash. It reveals the insolvency that was already there. The bond market begins to dictate policy, and the room for maneuver shrinks to nothing. Some economic historians note that the US possesses unique advantages that previous empires did not, specifically a dynamic technology sector and deep liquid capital markets that attract global savings during crises. They argue this demand for dollars will perpetually offset the risks of debt. However, this view ignores the fundamental arithmetic of interest payments. When the cost of servicing the debt consumes the entire tax revenue, no amount of technological innovation can bridge the gap. The incentive for the rest of the world changes from cooperation to containment. Under these constraints, the rational move for rival powers is to accelerate the transition, not to delay it. History suggests this resolves in one of three ways. First is a controlled decline. This is the path of post-war Britain, a slow managed reduction in living standards and global influence punctuated by periodic crises, but avoiding total systemic collapse. It is a painful decades-long adjustment where the currency loses value steadily and the population learns to live with less, while the geopolitical center of gravity shifts elsewhere. Second is a chaotic collapse. This resembles the Weimar experience or the Soviet unraveling, where the loss of confidence is sudden and absolute. In this scenario, the bond market freezes, the currency enters a freefall, and the complex supply chains that sustain modern life disintegrate. The social cost is incalculable, and the recovery takes generations, leaving deep scars on the national psyche. Third is a reset and restructure. This is the historical norm following major debt super cycles, similar to the Bretton Woods Agreement of 1940. For here, the burden of debt is essentially written off or inflated away. Through a new monetary agreement, the currency is pegged to a new anchor, perhaps a basket of commodities or a digital ledger, and the global financial board is reset. The only variable is timing and pain. Subscribe to the channel to track these developments as they unfold. Focus your preparation on education, resilience, and a clear-eyed attention to the data rather than the noise. Would you like me to extract the key economic stages mentioned in the text into a summary table?